मरघट तक है तेरी कहानी, पग पग प्यारे। दंगल 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 दंगल, सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे। दंगल 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 दंगल।
Great morning, my dear friends. Bhupesh Anand again in front of you. Lecture number 3, market efficiency. We will be starting today. Learning outcome number C, that what are those factors which can affect market efficiency. So we have discussed what is the meaning of market efficiency. We have discussed what is the difference between market value and intrinsic value. Now we are going to discuss that what are those factors, which affect the market efficiency. That if those factors are present, then it can affect directly the efficiency of the market. So this is learning outcome number C. Please take out your registers. Learn lecture 3, equity as a subject, market efficiency as a reading, and factors that affect market efficiency as learning outcome number C. Now, the first point which I want to tell you is the factors I can divide into two parts, the positive factors and the negative factors. We can divide the factors into two categories. It means those factors which will help market efficiency, markets being efficient, It means those factors which will help in efficiency are named as positive factors. And there are some negative factors which will push down the efficiency of the market. You're getting my point? It means those factors which will increase market efficiency and those factors which will decrease market efficiency. So market efficiency factors are divided into two categories, positive factors and negative factors. Now what is the meaning of a positive factor? Now there are two positive factors and three negative factors. Now when there are more number of participants available, there are huge number of participants. Now whenever there is a huge number of participants, it means it is a broad market. It means there are different categories of investors are there. Participants are there. It is necessary, or it pushes the efficiency of the market. So more the number of participants, more will be the efficiency. It has a direct or a positive correlation. More the number of participants, more will be the efficiency. More will be the transparency. More will be the chances, the probability that market value is equal to intrinsic value. More will be the chances that expected return is equal to required return. It means it has a direct relationship with the efficiency, and this is the efficiency. This is the feature of a market, that intrinsic value should be equal to market value. And the second point, more the information which is there, more availability of information, easy availability of information, costless availability of information, it will increase the efficiency of the market. So if you're getting a point, it will increase the efficiency of the market. So there are 2 points which are very important, which will help in positive effect. The first is that if the participants are more, then the efficiency will be more. And the second factor which is very important is in case the information is freely available and easily available, and it is a case of correct information, there will be efficiency. Just write down first point. Please open your registers. Register number 3, factors affecting market efficiency can be divided into positive and negative. Following is the list of positive factors. First is existence of large number of market participants. List of existence of large number of market participants. Existence of large number of market participants. More the number of participants, higher will be the probability that market price is reflecting its intrinsic value. More the number of participants, higher will be the probability that market price is reflecting its intrinsic value. Second, availability of more information which directly affects efficiency of the markets. And I have written one example. For one of the clients, we were working for African company. One of our clients, I cannot name it, but the problem which we face is that it is an emerging market and there are no disclosure requirements. It is very difficult for us to find out the data, and we cannot, the market cannot be efficient in these cases. So in case of emerging markets, in case where there are no disclosure requirements, there are no regulations, so as such it will affect the efficiency of the market. So information availability is second most important positive factor which should be there. And now we will be moving towards what are those negative factors. It means what are those factors which can affect or decrease the efficiency of the market. The first is restriction on arbitrage, impedient on arbitrage. You have heard of arbitrage. I have discussed in detail in derivatives and in portfolio management. It is a riskless profit when the same commodity is available at two geographical places at different prices, and you are aware of that. So you will purchase the commodity where it is being available at a cheaper price, and you will sell at a geographical location where it can be sold at a higher price. Think of gold in Dubai. People are purchasing gold from Dubai and they are selling into India because the gold price and the same quality, carat qualities, is cheaper in Dubai and it can be sold at a higher price in India. So this is named as geographical arbitrage. Now the point is, if the same security is available and in National Stock Exchange, Tata Motor stock is 50 rupees, and in Bombay Stock Exchange it is available at 40 rupees, it means there is a difference of 10 rupee, and you are aware of that. Then you can, what you will do, you will purchase it from Bombay Stock Exchange at 40 and you will sell it to National Stock Exchange at 50, and you can earn a 10 rupee of arbitrage profit. But what if there is a restriction on arbitrage? If there is a restriction on arbitrage, then 40 will remain 40 and 50 will remain 450, and there will be inefficiency in the market. So the first negative factor which you have to write down is impedient to arbitrage, that is restriction on arbitrage, that is prohibited arbitrage. So I have given the case study, I have just spoken for you that in NSE the same stock is available at, let it be 50 rupees, and in Bombay Stock Exchange let it be at 40 rupees, but you can buy it at 40 and you can sell it at 50, then the market inefficiency will reduce. But if it is restricted, then you cannot do like this, impedient to short selling. Now the point is impedient to short selling. Now what is the meaning of short selling? I have already told you what I mean by short selling. Now when I say short selling, it means if the intrinsic value, if the intrinsic worth is less and the market price is more, intrinsic value is less and market price is more, everyone will be ready to sell that because in future the value will decrease. But if there is a restriction in short selling, just write a B point. Impedient, it means restriction to short selling. Case study: if the value, intrinsic value is $100 and market value is $80, if intrinsic value is more and market value is less, then no problem. All people will start buying it, and there will be efficiency in the market because intrinsic value is more than market value. But I am talking of a next case study which I have just referred to you, that if market price is more and intrinsic value is less, all the investors will be ready to sell it. They will be going for short selling, and if they are ready for short selling, in that case, it will decrease, and if that there is a restriction in short selling, if there is no restriction in short selling, then okay, it will go for market efficiency. But if there is a restriction, then it is very impossible for that. C point: high cost of trading and gathering information. If transaction cost is high, if commission cost is high in National Stock Exchange or Bombay Stock Exchange, people will not sell, for a minimum for that much arbitrage, because it will amount to same amount because they have to pay the cost. So it can be a negative factor for market efficiency. It means if there is a high cost of trading, high cost of brokerage, high cost of commission, and high cost of gathering information. So that is a negative factor. Hope you have enjoyed this lecture number 3. These are the factors. Let me show you from Google Baba. I have just taken out for you what are the factors affecting market efficiency. Following factors affect the degree of which markets behave efficiently, number of participants, market generally behave more efficiently as the number of participants increase, more participants increase this, and let me move to this factors affecting market efficiency, and let us see what they have written. The number of participants, financial disclosure information availability, trading limits, transaction information cost, same points which I have just discussed. So these are the 5 or 6 factors which can affect the market efficiency. Hope you have enjoyed the lecture. Be happy, be jolly.